Growing a company so that it becomes something of value usually depends on its ability to raise money. But whether companies are seeking money from private investors or from public markets, their success in raising funds will often depend on their sector and their timing. I'm joined today by Alan Livsey, a writer on Lex, the FT's specialist analysis team. Alan, welcome.
Thanks.
I understand you brought some charts to show us, which are going to be showing something about what's going on in, or what has been going on in capital raising. So if we can look at the first one now, can you explain what we're looking at here?
Well, we're just looking very simply at the returns in certain sectors, global sectors, over the past 2 years in the stock market. And just to give you an idea of where the attention has been focused. So one thing that really sticks out is the energy and material sectors have had a terrible time.
Really bad time to have invested in those.
Very bad. And it's in the headlines and everybody knows about that. And on the other hand, it's been a reasonably good time for healthcare, information technology, and some consumer staples. So particularly those top two outperformers have had more interest, and it's probably been easier for them to finance. Having said that, on the other end of the equation, on the other end of the scale, the companies, particularly in the energy sector, they have also financed a hell of a lot in debt, and in doing so, were very active because they needed money because they were a little bit in trouble. So this just simply shows the global trend on mergers and acquisitions over the last 3 or 4 years. And what's interesting is A, they've been going up quite a bit. B, in 2015 they went up a lot, and there's been a real push to get deals done. And what's also interesting is that in 2016 it looks as though, at least on Citi's analysis, they're expecting some sort of slowdown in merger and activity. So that sort of gives us some sense of what could be coming on financing.
When we're talking about capital raising, what kind of spin does that give on the mergers and acquisitions thing? Do those companies need capital to make those deals?
Well, if they're really big deals, sometimes they will need to raise either debt or equity or both in order to perhaps finish and execute an acquisition.
Unicorns. Can you tell us first of all what a unicorn is?
Well, here's what a unicorn is: a privately held company, usually a startup over the last 3, 4, 5 years, that's chosen to stay private. Whereas once upon a time they might have rushed to the stock market, say, to list their company and raise money for the owners and the investors. Today there's less of that, and that shows in these unicorns. So we can see how that's building up over the time, and more of them are choosing to stay private. One of the most famous ones is Uber, the taxi service.
And so what do you expect to be happening for unicorns in the year ahead? Because, one of the things that's defined them is also that they have $1 billion valuation, don't they?
They have $1 billion valuation.
That's a lot of money.
It's a lot of money, and it makes for great headlines, but not all of them are really able to sell themselves for $1 billion. So this is going to be interesting. Can they actually continue to function as private companies without more financing from the outside, from the public market?
So in 2016 generally, do you think it's going to be a good year for raising capital?
I think it's going to be harder, and it's definitely going to be harder unless we see more stability in the world stock markets.
Alan Livsey, thank you very much indeed.